Did you know that once you retire, there's a powerful strategy that lets you turn your traditional TSP into a Roth IRA, which unlocks tax-free growth and income for the rest of your life? Just to be absolutely clear, if you are still working and want to learn about moving money from your traditional TSP to a Roth TSP within the plan, that's what they call the in-plan Roth conversion, and that's a different animal. It's got its own rules, and you can watch another video on that, and I'll put the link in the description below. But in this video, we're going to talk about the Roth IRA conversion ladder with your traditional TSP once you're separated from service or hit the age of 59 and a half while you're still in service, and you prefer to put your traditional TSP into your Roth IRA to handle that big pre-tax nest egg. Stay with me because I'm going to walk you through it one by one. Now, why is this Roth conversion so important to some folks? Well, it all boils down to the IRS and a little thing called required minimum distributions, or RMDs. The biggest problem with these big traditional accounts is that the government eventually stops waiting for you to pay the tax bill. When you hit a certain age, which is 73 if you were born between 1951 and 1959, or 75 if you were born in 1960 or later, thanks to the new Secure Act 2.0, the IRS requires you to start taking money out of your traditional TSP and other traditional IRAs. And you have to pay income tax on every dollar. If you have a sizable balance, that mandatory withdrawal, that RMD, could significantly increase your tax rate year after year. It can put you into a higher tax bracket than you ever expected in retirement. And that's a painful surprise, let me tell you. The whole point of the Roth conversion ladder is to shrink that taxable balance before the RMDs kick in. Now, listen to me closely, all right? This is complex stuff with serious tax implications. So you absolutely, positively should consult a tax professional before you take any action. If you don't know where to start, you can always schedule a consultation with me at firesightship.com/consultation, and I will walk you through the process. Now, let's break down the accounts we're dealing with because you might have a mix of all three. And if you already know how these work, you can always skip to the next segment of this video to see how a Roth conversion works. First, you've got your traditional TSP, and that's the workhorse for most federal employees and military members. It started back in 1987 and was designed to look and feel a lot like a private sector 401k. It's tied directly to your employer, which is the federal government. You contribute pre-tax dollars, you get the tax break today, and your money grows tax deferred. And it sounds great until retirement rolls around, and suddenly every dollar you take out is taxable as ordinary income. Back then, it was a huge step forward. Before 1987, the retirement picture for federal workers lived mostly on a pension, and the TSP was meant to give people more flexibility, more ownership over their retirement money, and let's be honest, a way for the government to modernize benefits and keep up with what private employers were offering their workers. And that's why so many folks today have large traditional TSP balances. They have been contributing for decades, and some since the very beginning, long before Roth TSP was even an option. And that's the root of today's problem. A lot of you are sitting on these massive tax deferred accounts, which is great for growth, but not so great when the IRS forces those required minimum distributions down the line. Now, some of you also have a Roth TSP, and this one is the newcomer, right? And did not show up until 2012, which means a lot of career employees already had big traditional balances before Roth even existed. The Roth TSP is a retirement savings option that works differently from the traditional TSP. The Roth TSP flips that around with contributions made after tax, meaning you pay taxes up front, but both your contributions and the growth can be withdrawn completely tax-free in retirement if you follow the rules. This gives federal employees a way to trade paying taxes now for tax-free income later, which can be especially valuable if tax rates rise in the future or if they end up in the same or even a higher tax bracket during retirement. Now, the third piece of this puzzle is the Roth IRA, which is another account you will want in your retirement toolbox. And the big difference between this and the Roth TSP is that the Roth IRA is yours alone and not tied to your employer. You can open it with any bank almost, and brokerage or financial company, and it gives you more flexibility in how you invest and withdraw your money. So here's how it works. A Roth IRA is an individual retirement account that you fund with money you've already paid taxes on. The big benefit is that once the money is inside, it grows tax-free, and when you retire, both your contributions and earnings can be withdrawn without owing any taxes, as long as you follow the rules, right? The money you roll over from your TSP to your Roth IRA does not count towards your contribution limit for the year. But the key difference here is that a Roth IRA has 4 parts, which are the contributions, earnings, rollovers, and conversions. The contributions you put in are made with after-tax dollars, which means you can always pull those back out tax-free and penalty-free. The earnings, on the other hand, that's the growth and investment returns. Stay tax-free as long as you follow the rules when you withdraw them in retirement. Then you've got rollovers, which are just transfers from other Roth style accounts like a Roth 401k into your Roth IRA. And finally, there are conversions, where you take money from a traditional account like a traditional TSP or IRA, pay the taxes upfront, and move it into your Roth IRA so it can grow tax-free from then on. Simply put, your Roth IRA is your personal retirement account, completely separate from your job, and it gives you another layer of tax-free income in retirement to go alongside your TSP. Now, let's talk about how the Roth Conversion Ladder works, specifically with your TSP. But first, you have to be separated from service, meaning you're retired to move that money out of the TSP without penalty or be at least 59 and a half while still employed. So let's assume, for the sake of simplicity, that you have done it. You've retired completely at, say, age 62. One of the steps you can take is what they call a direct transfer or a direct rollover to your traditional IRA. You request this transfer from your traditional TSP to a traditional IRA, then you have opened with your chosen brokerage. The TSP then sends the money straight to your broker. And this step is crucial because it is not a taxable event. You're simply moving pre-tax money from one pre-tax bucket, which is the TSP, to another pre-tax bucket, which is the traditional IRA. You can do a partial rollover, moving just a chunk or moving the entire balance. And I'm telling you, get the brokerage name and address right, because the government forms are pretty serious about that kind of detail. And once that money is sitting in your traditional IRA, that's your conversion fuel. Now you need to strategize exactly how much you want to convert to your Roth IRA each year. If you don't want to take this extra step, you can always convert directly from your traditional TSP to your Roth IRA. Either way, this is where you put on your tax planner hat, because you do not want to convert the entire amount at once if you have a large balance. Why? Because the amount you convert is added to your income for that same tax year. Convert $1 million in 2025 and you will have $1 million of income in 2025, pushing you into the highest tax bracket, which means you'll pay a fortune to the IRS. That's not a strategy. That's just a bad day. The smart move is to spread it out, because that's the whole point of the ladder. And let's say you're 62 and your RMD age is 75. You've got 13 years to chip away at the balance. In year 1, you decide to convert, say, $50,000 from your traditional IRA or traditional TSP to your Roth IRA. You need to know what your marginal tax rates are, both federal and state. If your total income for the year keeps you in the 12% federal marginal tax bracket, that $50,000 conversion is going to cost you $6,000 in federal tax plus whatever your state takes. You need to have at least $6,000 plus state taxes sitting in cash, ready to pay the tax bill, because you do not want to let your traditional IRA withhold the taxes on your behalf from the money you converted, because then it completely defeats the purpose of tax-free growth. You want the whole $50,000 to grow tax-free and not $44,000, right? Then you repeat the process year after year from age 62 all the way up to 74. You want to make sure your effective tax rates are sustainable. The more you convert, the higher the tax bracket you might end up in. So you need to find the sweet spot. For many people, that sweet spot is converting just enough to stay within the 12% or the 22% or sometimes 24% in the federal tax bracket, really depending on your personal situation. Now, a huge consideration for you guys who are approaching 65 is something called IRMA, the Income Related Monthly Adjustment Amount. This is the official name for the surcharge on your Medicare Part B and Part D monthly premiums. The monthly premium amount will increase if you decide to convert more to your Roth IRA. Why? Because the amount you convert to a Roth is counted in your adjusted gross income, and Medicare uses your AGI from 2 years prior to determine your premium. So a big conversion now at age 63 can give you a nasty surprise premium hike at age 65. The higher your AGI, the higher your monthly premium will be. And this is a real ongoing cost that has to be factored into your annual conversion number. But the payoff is that by the time you turn 75 and your RMDs finally begin, your traditional TSP and IRA balances will be much, much smaller. And that will significantly lower your required withdrawals and reduce your lifetime tax exposure. At the same time, all those annual Roth conversions have been compounding and growing tax-free in your Roth IRA, and they will never be subject to RMDs. And this is the difference between having the government tell you how much to take out and having completely tax-free control over your own money. But what if you have a huge traditional balance and you're already past 70 and a half? There's another excellent strategy for reducing that RMD tax burden called a qualified charitable distribution, or QCD. The rule is that once you hit age 70 and a half, you can direct up to $108,000 from your traditional IRA directly to a qualified charity. The money is never counted as taxable income to you, and it counts towards satisfying your RMD for the year. So if you're already charitably inclined and you have a sizable traditional IRA balance, this is a beautiful way for you to reduce your taxable income and support a cause you care about. Bottom line, the goal of this entire conversion strategy is to balance your withdrawals and conversions from Roth and traditional accounts. By doing this, you can help yourself manage your tax bracket so much better each and every year. You're trading a small manageable tax bill now for a much larger mandatory tax bill later on. Now, let's switch gears for a second and talk about why so many financial experts, myself included, believe this strategy is a smart move right now. The argument is that tax rates will rise in the future. Why? A few reasons. First, you have a rising national debt. I don't care what side of the aisle you're on. The numbers are just astronomical. At some point, this bill has to be paid. And historically, the easiest way for a government to raise money is to raise taxes or just inflate the crap out of it. And second, we have a decreasing birth rate. And this might not sound like a financial issue, but it absolutely is. Fewer workers mean fewer people paying into the system to support a growing number of retirees. The math just does not work out. Third, increasing healthcare costs are relentless. Medicare is a huge part of the federal budget, and those costs only go one direction, and that is up. And that requires more funding, which again usually means higher taxes. Finally, we have the ongoing issue of Social Security funding. The system is projected to run short of funds in the next decade. There's talks of raising the cap on income subject to Social Security tax, increasing the contribution rate from the current 6.2% or a combination of both. Whatever they do, it points towards higher tax obligations in the future. And when you put all four of those trends together, you realize that paying a 12% tax rate today on your converted money could save you from paying a 25% or 30% rate on that same money a decade from now, or maybe 2 decades from now. The Roth conversion is essentially tax insurance against a future you cannot predict, but which certainly looks more expensive. But again, your personal situation is going to be different from everyone else. You may not even need to do the Roth conversions, so be sure to talk to a professional before making a big decision. And that's the Roth Conversion Ladder for you. Not complicated once you see the steps, but it's powerful if you work the plan. You can move money from your traditional TSP to a traditional IRA and then convert chunks each year into your Roth IRA, or you can directly convert your traditional TSP to your Roth IRA. And it's up to you, but you just want to make sure they don't withhold any taxes on your behalf, or it completely defeats the purpose of that tax-free growth in your Roth IRA. Remember to pace yourself so you don't spike your tax bracket or blow up your Medicare premiums. By the time RMDs roll around, your traditional balance is going to be smaller, or your Roth balance is going to be bigger, and your tax situation is much more under control or manageable. Now, look, I'll be real with you. This strategy is not for everyone, and some of you might not even need it. Some of you might have other income sources that change the equation. But for many federal retirees or military retirees sitting on a big TSP balance, this ladder is one of the sharpest tools you can use to protect your retirement from taxes eating away at it. And I'll leave you with this reminder, and that is planning is everything. And if you don't plan, the IRS has already made a plan for you. And trust me, it's not in your favor. So think through your numbers, talk with a professional, and if you do it right, this strategy could save you tens of thousands of dollars over your lifetime. And don't forget to check out the other video about the in-plan Roth conversion with the TSP. And this has been another beast of a video, and we got a lot out of it.